Welcome to Financial Detox. We're your hosts, Jason and Alex from IDA Wealth. Your financial journey of pursuing better and true financial peace of mind starts here. Hello, welcome to Financial Detox. I'm Jason Labrum, your host with my man and co-host,
Alex Klingensmith.
What's up, Alex? How are we doing?
Talking about taxes today.
We're excited for 2026 for you, our listeners, because we're going to get specific. We're getting focused, and we are going to talk about very on-topic, specific things that should resonate with you. We're going to be brief in these videos, so when you check them out, you can know that you got about somewhere between 8 to 14 minutes or so. You're going to be able to consume some really good information and then go on and get more information if you want on other topics. Where before we did a lot of like theory, right, Alex? We talked a lot about who we are, what we do, and just different stories. And we'll dovetail lots of stories into these short clips too. But it became a little conversational, and we're trying to get more specific for you this year.
Apparently, attention spans are shorter nowadays.
That's what I heard that has happened. So
you guys 5 seconds to get to the point where we lost you. Okay,
right.
Tax drag.
There you go. We're talking about tax drag today. And this is important. We want to talk about and help you understand the evils of tax drag on your portfolio. Now, what does that mean? I bet you've heard of the statement. It's not how much you make, it's how much you keep that matters. And that ties into what we're talking about today. So how does tax drag happen in a portfolio, Alex? Let's walk through just a couple things. What would cause tax drag?
I mean, layman terms, my understanding of tax drag, it's not taxes paid one time, it's the annual erosion over time through compounding. So it shows up as ordinary income, capital gains, state taxes, embedded turnover, forced distributions. It just compounds and compounds. You want to hear a quick, this is some math that AI did for me real quick. So hopefully it's correct. You never know, right?
Yeah.
I believe the first one. So if you're talking about portfolio A versus 7% gross return, and then you talk about a 6% after tax, I get to keep that return. If it's 1% difference over 25 years, it's about 30% less money 25 years later. If it's a 2% difference, it's half the amount.
Is that Christy, pull up the chart, because this is on point to what Alex is saying, where we have hypothetical growth of 500,000 over 20 years.
There you go. It's like I'm clairvoyant here.
And we'll see if Christy could share this screen for us. But this is exactly it. It is clairvoyant, Alex. Whoa. I mean, here's an example, right, where you take a $500,000 investment, your account type, whatever, figure it out here. But you look at the difference with no tax drag is 2.1 million. With 1% tax drag, you have 1.7 million. With 2% tax drag, 1.4. I don't think 1 or 2% tax drag is unusual for most investors to face and deal with.
Really common, actually.
So I think it could come from, Christy, if you show the other slide about the stock sell too, because that's a very interesting slide. Because Alex, you mentioned, I think, a really good point about how tax drag can happen over time. It's not necessarily event driven. It could just be, how are you offsetting the ordinary dividends that you have or the interest that you're receiving from bonds or fixed income. But there are single events that could happen too. This was just a chart we pulled off the internet of an example of somebody who had Meta stock, right? You have 100,000, you sell the stock. All right, I've got 100,000 in cash. That's great. But unfortunately, I had to pay $35,000 in tax from state and federal capital gains tax. Then I take that money and I go buy myself an S&P 500 index fund. I only have 65,000 to invest, even though I had 100. And it may take years and years and years to grow that back to 100. You haven't gone anywhere. You have the lost bucket, so to speak, or the frying pan of lost returns through tax drag. So this is really important to pay attention with your portfolio, and something that we've looked at for a really long time. And I think we have to talk about it more so that people understand it and can start making changes to improve your portfolio.
I think yield is a good one because people, you hear about like, I want a high yield investment. I want something that yields, whether it's a REIT or a bond fund. What's the problem with yield though when it comes to tax drag? What kind of tax is that, right?
Yeah, well, it may be qualified dividends if it's a qualified dividend stock, but there's a good chance It's not a qualified dividend taxed at a higher rate, or even worse, it's taxed at ordinary income. And so these things make a difference. I'm going to pull up a screen because I think this does something really special, and it gives you an insight into how you can plan and prepare for this in a way that will change your life financially. So here's a client. We ran their portfolio value, and we're looking at their portfolio value over their life, and they're doing great. They're not spending more than they make. They are going to end up with lots of money at end of analysis. The problem was we looked at their portfolio and we said, man, you own a lot of mutual funds, which are not tax efficient. You also own a lot of ETFs, which don't allow you very much tax loss harvesting opportunity versus maybe a direct index or a custom index that we build for you. And then also they were only looking at tax loss harvesting once a year at the end of the year. So we said, let's just update a couple of these things. Let's just take your mutual funds and move those to a direct index, where instead of owning a mutual fund that in turn owns individual stocks, we're going to just buy the individual stocks for you. We're not trying to stock pick. We're not trying to play the guessing game, but we're going to buy a bunch of stocks that have really high quality fundamentals, diversify them. And then even when your portfolio is up, some of those stocks will be down. We'll tax loss harvest those throughout the year by a very similar position, an equivalent position. So your portfolio hasn't changed, but yet you got to harvest that loss. So by changing this strategy for the client and making just a few small changes, these were not even monumental changes, and there was no tax consequence to even make these changes. This client was able to add an extra $3.3 million to their portfolio over their life by reducing the tax drag on their portfolio. One simple change: reduce the tax drag by implementing a custom index. They were able to literally change their situation. And I think we grossly underestimated the benefits of that tax drag reduction strategy. I think it was actually significantly more than that when you really unpack it.
I bet most people don't even see this either, right? Because they're showing pre-tax returns. They're pointed to benchmarks or strategies where the after-tax returns just aren't readily available, right?
Yeah, I had a client look at 3-year returns here the other day, Alex, and they're like, "Wow, it's amazing." And I said, "Yeah, but that is gross returns, right? There's still some taxes. So let's go look at the taxes." And we had done a bunch of tax planning. And I said, the good news is the tax drag on your portfolio was almost nothing. So you do get to keep a lot of that. Had we had an investment strategy that you came to us with, there would have been a different tax scenario. So let's just summarize it here and pack this out, because what we're talking about today, for you, our listener, we want you to be really acutely aware of this, because it can make a major difference in your amount of money that you keep. It is not how much you make, it's how much you keep. And if you're losing 20 or 30% of your returns to taxes, you probably don't have to do that. There's probably a better way. But I think the number one thing that we talk about a lot, Alex, on previous shows when we were getting into theory, we would always kind of weave these topics in and out. But we talked about tax sensitive asset location and how that's so important to make sure that you put the right assets in the right accounts. Right, we spent a lot of time talking about that. And what does that mean? It means that if I have an investment that pays a 6% yield and it's taxed at ordinary income, and I have an ordinary income rates, and I have an option to put that in my trust or my investment account where I pay that ordinary income tax, or I have an option to put that in my IRA where that yield is sheltered from income tax, I probably want to put it in the IRA, but not a lot of people do this.
No, they don't. I think the call to action too is, if you're listening to this show and you suspect that you might be falling victim to 1 or 2% a year tax drag, and you're not really sure even how to tackle the problem, we invite you to have a conversation.
Yep, it's pretty simple. You can we can run a tax analysis for you on your portfolio and show you kind of what we're doing there and how that works. So I think you want to know and understand what tax sensitive asset location is, not just not just asset allocation, but what is tax sensitive asset location. I think you want to understand if you have more than $500,000 to invest in stocks or equities, the equity portion of your portfolio, you definitely want to understand custom indexing and direct indexing, where you own the individual positions as opposed to owning them through mutual funds and or ETFs. I think you want to look at other strategies too. If you're having a liquidity event or some potential large capital gain, there are some things you can do through direct indexing to enhance the tax deductibility and create additional tax losses too. So that would be another one. Anything else as we close that out, Alex? We talked about, tax drag, being aware of it, making sure that if you pay just a little bit of attention to this, I think you can make a significant impact in your net returns.
Have the conversation. If you're not already having it, have the conversation. Ask a lot of questions about it, not just to your CPA or just to your advisor, but getting them together actually in one room and having them debate on behalf of your after-tax returns is a really powerful thing as well.
Yeah, that's a really good point. Bring your CPA and your advisor together. They should be talking. And if they're not, try and get them connected so that they do. Thanks for tuning in on this episode of Tax Drag and how it's maybe destroying your portfolio. Time to make a change. Check it out. Thanks for watching. As always, I'm Jason Labram with Alex Klingensmith, and we will catch you on the next episode of Financial Detox.